Is now starting. All attendees are in listen-only mode.
Hello and welcome to this webinar. I am Devarsh. I'm from HDFC Securities Retail Research Department. And today this webinar is about the market outlook for 2023. So let's start. So agenda for this webinar is that first I will take you through the macroeconomic environment for 2023, what happened and what are our expectations for 2023. The same is the case for the global macro, what happened in 2022 and what do we expect from the next year. We'll discuss our Indian equity market strategy. We'll also talk about the expectations from the upcoming union budget and why it is so important an event. What are the sectors which we can bet on in 2023? What stocks HDFC Securities Retail Research Department have recommended to be accumulated in 23? Also, at the end, I'll talk briefly about the gold and the currency outlook and investment advisory for retail investors. So this broadly 8 points I want to cover over the next 35-40 minutes. So let's start. So global and Indian macroeconomic environment was quite challenging for 2022. A lot of events happened which were not expected before the year started. So all in all, it culminated to almost flat performance for Nifty, and Nifty small cap and mid cap had a bad year. They went down compared to a stellar return of 2021. 22 indices struggled. If you look at the composition of various sectors, IT was the worst performer, followed by healthcare and consumer durable. They were down by respectively 18% and almost single digit 9 and 7%. Power, auto and bank were one of the top performers. As the lockdown closed and the corona related worries were over, throughout the 2022 we saw economy picking up and that led to a demand in power sector. Automobile also supply constraint got over and that helped resume their sales. Let's look at the macroeconomic variables. So the theme is that throughout the 2022, gradually Indian macros improve and they are gradually improving. If you look at the overall GDP growth, whether the industrial credit numbers, the IIP numbers in capital goods or in electricity side, gradually we are seeing a uptick in 2022, later part of the 2022, and we are seeing that the same trend is continuing in 2023 as well. Look at the GST collection, steadily around 1.5 lakh crore we have now collected. So this collection is even better than what was expected in the budget, and that has given the government a lot of room to do other stuff. The household assets in equity is also gradually improving on back of steady flows of SIP, and in the 2022 year, the bank credit has bottomed out, and now gradually we are seeing a good growth in bank credit. Good. So credit is the foundation on which GDP growth can come, and that is also showing signs of improvement. So what are the other triggers for the Indian markets, Indian economy in 2023? So the investment to GDP ratio is likely to be around 33%, and that is a good sign. We expect that the government, on back of robust tax collection, will collect higher infrastructure spending and capital spending. So real estate sector and the construction sector can see a major revival. The government scheme based on PLIs and the manufacturing of India is now seeing a resurgence. We are seeing a lot of jobs being created in the manufacturing sector. New technology related investment and sustainability led investment like in alternate energy, in green hydrogen, all those events, all those industries are attracting new capital. Railways, road, defense, all these sectors are seeing a lot of inflows of investments, and this is likely to have a ripple effect across the economy, and that will help to boost the GDP growth going forward in 2023. So compared to the global markets and global economy where there are certain challenges, the growth side, India is looking good. The supply chain are being continuously decoupled from global MNC players from China and other parts of the world, and they are looking for new homes. And many countries in ASEAN and in India are likely to benefit out of this Europe plus one and China plus one strategy being implemented by these foreigners. So India is going to be a major beneficiary over the next couple of years of this change in the supply chain. The flow side, we saw that the foreign portfolio investors sold quite heavily, around 1.5 lakh crore worth of stocks being sold by them. That was equally absorbed by domestic institutional investors. Net, whatever was sold by the foreigners was absorbed, and that's why we see that at the large cap level, at the Nifty level, where we started the 2022, more or less we end near that. So the flow of, this is the chart which suggests that the 12-month FI flows compared to Indian market cap, and both are positively correlated. As FI purchases heavily amount of stocks, our market cap shoots up, and when they are selling, we are more or less stagnant. And because we are not crashing like what happened here in 2008, the market has traded near the baseline is because of these flows. So continuous SIP contribution is helping. The direct equity has taken off, and huge amount of new accounts have been opened in 2022. The mutual funds also have collected good amount of money, and that has helped Indian market outperform the global markets. So what are the worries for Indian market? Valuation is the major worry compared to other parts of the world like China, which is almost half of the market cap to GDP, or even Germany. UK is also below 1. Indian markets are almost trading at a 1 market cap to GDP, which is only lower than the US, which is very high. All other markets are relatively cheaper than India. So this suggests that the forward valuation. So Indian markets are trading at a quite aggressive future valuation compared to other emerging markets and compared to India's history. So if you see MSCI India relative to emerging market, we are near almost 2 times standard deviation. So we are quite high. Indian markets have seen the PE, which is almost 16 for last 10 years average. Now we are trading near 18. So we are quite aggressively valued. And that is one of the worries for our market. What are the other worries? Core inflation remains a worry, and it is entrenched at a higher level. Higher crude oil prices or gold prices, usually this kind of things do reflect in India's inflation. The next year, the expenditure is expected to the budget estimate in government scheme like Manrega, and current account deficit of 1.2% in 22 is likely to widen to further in 3.3% in FY23. So this 3% trade deficit is also a concern, and that has put a pressure on Indian rupee. Indian rupee did perform very poorly in 2022. Now worry is that if there is a broad and deep recession in US, that may lead to slowdown in Indian earnings, and that will consequently make an impact on Indian currency. If there is a broad recession in US or a deep recession in US, that will have an impact on USD, and that will have an impact on balance of payment. India is a net importer of oil and fertilizer, and if there is currency depreciation, that may put a pressure on Indian economy. So these are the worries for 2023. The trade balance, the current account deficit, the current account balance, and GDP growth all are related to currency, so we have to worry about that. Other than that, our liquidity in the system is earlier, which was quite surplus, has gradually got into deficit because of the high interest rate and other measures taken by the RBI. So this surplus liquidity, which led to a lot of increase in the investment multiples, the valuation multiple, that room we do not have any further. So only companies where the earnings are likely to be higher than the market expectation, those companies are likely to give us return in 23. The return based on expansion of multiple, we hardly have any room, because the valuation multiples are stretched and the liquidity is now in the deficit. So emerging markets are likely to benefit compared to the other parts of the world in compared to 2022. But India's outperformance in 22 may take a breather in first half of 23. Going into second half, we think that the will start factoring in the impact of the general election, which are slated in May 24, and with outright repositioning or considerable hedging of the portfolio, depending upon the political situation in the second half of 23, and how government central policy impact India's macro and stock market performance will also determine how Indian election outcome is going to be. So for 24, the general election is a very important event, and that event's outcome market may start factoring in from the second half of 23. So after May, June, you start thinking about it. The IPO, FPO, and OFS issuance can rise in 23. And compared to 22, we expect that the foreign portfolio investors will be quite positive on India. The rate cycle may pause near 6.5. So we have about another 0.5% or 60 basis point to rise from here. From that level, we expect the interest rate hike to stop, and that will also have a positive impact on markets on the second half. Now, if global economy slips into recession, and that would be bad news for India's exports, because out of India's GDP, 20% is dependent on exports. So we have to worry what kind of global macro situation is likely to be there in 23, and I will cover that portion of India's macroeconomic situation. So India's relative valuation is little stretched, and though we have higher growth prospects compared to other emerging markets, our valuations are also already discounted a lot of that growth, and we have to be mindful of that fact. Compared to other parts of the world, our equity markets have shown a lot of resilience, and we have already outperformed all major markets in last 2 years, and that's why we need to be a little cautious on the equity and the indices front. Now, range of policy reforms implemented over the recent years need to go into the earnings growth, and if earnings growth leads to higher flows into equities, then our markets will also perform. So all in all, a tough first 3 months to 6 months for our market. Post that, we expect a better environment. So our advice is to remain buyers on the dip in this market. For first half, whatever dip is to happen, you should gradually accumulate stocks. Now, one more segment which is likely to do quite well is the small cap stocks, because the relative valuation suggests that they are still comparatively quite attractively valued compared to Nifty. These small caps are actually likely to benefit from the current backdrop of higher inflation. They are also a biggest beneficiary of the reshoring or the capital expenditure boom, which we think will happen in 23. So small caps are the biggest beneficiary, and government spending on various sectors are likely to help these small caps. The services spending will also help small caps. And as the interest rate hike stops, US and in India, so as Fed stop and most probably will start cutting rates in the later half of 23 or early part of 24, that is the time where small cap stocks starts outperforming. So within this segment, we prefer small caps in Indian market for 23 to outperform the larger indices. So that was about India. Now let me take a tour of the globe. Let us look at the global macroeconomic environment. It was a very tumultuous year for global indices, 22. As you can see on the screen, indices like Nasdaq had a very bad year, terrible year. Almost they are down by 27%. Taiwan was down 20%, and many parts of the world, they were all in a mid 10 to 15% kind of a negative performance was visible. Only countries like India and Brazil managed to give some positive returns, single-digit positive returns. On other asset classes, emerging markets, whether China, Bitcoin, or US Treasury, all had a very terrible year. Performance were down between 15% to almost 60% in Bitcoin. Only thing which worked was the commodities, especially the crude oil and the dollar index. They managed to perform. And India, one of the outperformers, also managed the year with a 4 to 5% gain compared to most of the asset classes which were in negative. Now, we think that the US market usually bottom out when the interest rate cycle peaks out, and then when Fed starts cutting, that is the time when US market bottoms out. Here we see that this is the chart of the US Fed rate, and these 7 lines, vertical lines, are the date on which US markets bottomed out. So as you can see, on all these 7 instances, the US market bottomed out post the interest rate cut, first or second interest rate cut. After that, US markets bottomed out. So that suggests that the US economy may go into recession, and if that recession were to come, US Fed will start cutting rates, and that is the time where US market will start booming, and that will have an impact on all global markets. So this 22 has been a very bad year for the US market, the FANG stocks or the Nasdaq stock. As you can see, huge erosion of market capitalization happened. Between 10 to 15 trillion dollar got wiped out. Almost 60% of the money was invested in Bitcoin got lost, and many of the FANG stock had a terrible 22. Many stocks are from point to point, they were down between 15 to 30-40% also. The cryptocurrencies, the number zoomed. Almost 21,000 different kind of cryptocurrencies got floated, but most of them will result into they will have a ignominious death. They will have a expiry near zero price. So what happened in the 22 is that though environment was not that conducive, the money which was transferred by the US Fed and US government into the bank accounts of the people, almost $10 trillion were there, and that has led to the reduction in debt. Now you can see that the government debt went up, non-financial corporation debt was more or less steady, but the US corporate, US household debt took a huge downturn, and that has left the Indian US economy in a good shape. That money is gradually winding down, and as in 23, first half of 23, they run out of this money. That is the time where we have to see what kind of impact is there on the economy. The dollar also has around October month peaked out, and it is now correcting. We have to see it has come down to a very attractive level, depending upon whether it is a very sharp recession or a mild recession. Dollar index will behave, and that will have an impact on global markets. The inflation has more or less peaked from 8.2 levels. It's gradually come down to 7.7 and even lower. If this peak is not surpassed, then dollar will also come down, and that will have emerging markets compared to DM markets. So global GDP estimates are about 3.2% in 22, which is 2.7% for 23. So many estimates are there between 2.5 to 2.3%. So it's not going to be a very strong growth, but it is going to be nevertheless a positive growth. And Chinese economy is also coming back from the COVID restriction, and it is showing positive growth. Now the important point to note out is that the Chinese people have almost 50% higher capital in their bank accounts than what they were before they went into the lockdowns. And since now China has left the zero COVID policy, huge boom in consumption is happening. That may have an impact on the inflation. And if that inflation doesn't come down, again we can have a policy tightening in across the world, and that may impact the market. So we have to see how much commodities responds to this Chinese economy opening in 2023, and what kind of impact does that have on global economy. So that is the point to ponder for 23. One more area where there was a lot of destruction of wealth was in IPOs. 123 tech IPOs in 21 compared to that. Usually average was 38. So huge amount of IPOs came in 21, and 690 special purpose acquisition companies or SPAC went into the market. These are the companies where there was no business. They were created to acquire other companies or acquire business. Many of these SPACs were even don't know what they are going to do money. They just raise capital when it was available freely, and now all this money is being destructing the wealth in the US market. So as you can see, the CNBC's post-PAC index has terrible performance in 22. A lot of money has been destroyed by these companies, and that is likely to have an impact on consumption in 23. So to sum it up, global equity market have seen the worst phase of bear market, loss of excesses and froth which taken place in the S&P. That is now down. S&P is down from 22 P to almost 16 P, now 17 P. And next two phases, that is the calculating the impact of rising interest rates on economy and the impact of these rising rates in corporate earning is needs to be checked. Again in February, Fed is likely to increase the interest rate. Now, what kind of impact that has on the corporate earnings will determine the trajectory of US markets. And the capitulation, the extreme capitulation by the US investors, we haven't seen. If higher interest rate leads to sharper recession and a deeper recession, and if there is a capitulation, that could be considered as a ultimate bottom from which a new foundation of a new bull market can come in 23. So we have to see what is the pass-through impact of a tighter monetary policy, especially in the first half. Q4 22 and first half of 23, we expect that the most of these things will get over. The optimist view is that the global weakness in the GDP will be short and shallow, and that means that the most of the markets would bottom out by March and April. And optimists feel that the negative triggers which were there in the 22, like higher commodity prices, higher food prices, Russia-Ukraine conflict, the increase in US bond yield, China's lockdown of economies and COVID curbs, all these bad news are already into price, and that will means that the economy will boom and markets will come back in the second half. But pessimists feel that again there could be hard landing. The increase in interest rates which are happening now may lead to a spillover in the earnings in second half of 23, and if that happens, that will lead to cut in the corporate profitability, and that will lead to EPS downgrades, and US dollar will become stronger, and that will have impact on global markets. So this is a evolving situation, and we will keep a tab on it, and we will update our investors from time to time what is the situation and how is it panning out. Right now, what we see is that the market typically bottom out 6 months before the end of the recession. So provided that most of the economists expect the recession to bottom out in the first half, we can expect that by third quarter of 23, we can have a market making a bottom. So in the first half, market should bottom out and market should start moving up. Moderate recession is already priced in the market, and we see that the indices have already had a steep fall. So S&P 500 from its peak already went down 25% by September 22. Historically, such a large fall usually leads to a better year for the market on the next year. So after 25-30% fall, we don't expect such a sharp downturn in the market, even if there is a recession in the US market. We don't see that it like 1950 or 2008 financial crisis or a dot-com bubble burst in 2000. That kind of scenario is not likely to happen in 23. One more important event which is there in the Indian market is the 23 Union Budget. Now this budget is going to be presented at a time where we are witnessing a geopolitical uncertainty and a slowing global growth. We have inflation at the domestic market, and our currency has depreciated to a large extent. So government will have to focus on augmenting the drivers of the domestic growth, and will also have to keep the inflation under check. We feel that the government will keep the fiscal prudence, and it will not resort to any big ticket radical announcement or reform in the next budget. The focus should be on the infrastructure development, on broad-based capex and manufacturing-led growth, and that will help a lot of capital goods and infrastructure-related companies in the 2023. The gross tax collections have been quite positive. We have seen that the collections are much better than the budget estimates, and that is expected to have control over the fiscal deficit. And because of that, fiscal deficit is under control. We see that the union budget will focus on growth next year by keeping lower fiscal deficit around 4.5%, from 6.4% now to 4.5% by FY26. That should be the trajectory. And because of the fiscal room provided by the strong tax collection and lower deficit, we think that the government will fuel the growth by putting a lot of money into public infrastructure and investment. And these investment and capital expenditure usually have a multiplier impact on the economy. And because of that, we see that the employment generation will take place, and that will help consumption growth into Indian economy. To summarize, we expect a investment-led growth, and that will be helped by the government's lower support from the direct fiscal side, and it will help the key consumption areas of the economy. Now let me look at the various sectors one by one. So BFSI is our top sectoral pick for short to medium term. We prefer large private sector banks here. These banks are likely to have a huge growth. We expect that from FY24 to FY22 to FY24, the PAT of these companies are likely to grow by 26%. NIM are expected to gradually compress, but that will have a slighter impact on the margin, but overall growth numbers are likely to be positive. Insurance and capital market, structural growth stories like financialization of savings is going to be played out in this country over the next decade. So BFSI should be the major part of anybody's portfolio. IT is a structural growth story, but FY24 we expect about 10% of the growth in PAT. The largest risk on this industry is the demand from Western markets and deal finalization. If there is a deep recession visible, then it may lead to some delay in deal finalization, but eventually the longer term theme of cloud adoption and digitization of industries is going to help Indian IT industry over the longer term. So IT remains a buy on the deep kind of a market sector for us. Three sectors where we are very bullish on 2024 and where stock specific opportunities needs to be looked is the first is, as I mentioned, on the industrial, real estate, infrastructure and building material, because we think that these industries are likely to have a good year. Another opportunity is the gas companies where valuations are very attractive and government policies have started becoming quite conducive. Chemical theme is going to be one of the major beneficiaries because of the Europe +1 and the China +1 story is being played out. So longer term growth visibility is here, and because of this we expect a lot of specialty chemical companies to do quite well. Power demand has spiked post reopening of the economy, and this is a structural story. In addition to renewable energy, most of the power companies are stepping up their capital expenditure, and that is likely to have a good profits. For future investors, for if you think about very long term, next 3 to 5 years, 10 years, then there are two new opportunities emerging, and we will keep an eye on them. As and when there is some opportunity in the form of companies which are being right now thinking of large investments, chip manufacturing is going to be one of the big areas where we see that a lot of foundries will be created into India. Right now, there are talks of Vedanta working with Foxconn, IGSS Venture, ISMC with Tower Semiconductor. Now, any of these investment fructifies, and if they have a listed entity, we would like to keep an eye on them. Similarly, electric vehicle and electric mobility is going to be a theme, not only on the OEM side, but we will also look at the cell manufacturing and other electrification of transport related opportunities for longer term. So for people who are looking to invest for a 3 to 5 years, electric vehicles is also one theme which we need to keep on radar. And one more theme which is for a longer term, for next 3 to 5 years. Earlier, the Indian market was dominated by the multinational brands. Since liberalizations, we've seen that the many companies came into the market and they cornered the market share. But gradually now they are ceding market share to domestic counterparts. and whether it is pharmaceutical, banking, chemical, paint, or FMCG, Indian homegrown brands are now growing faster than the MNC, and this is a theme which we need to play. So we think that this trend is going to continue. So continue to bet on Indian entrepreneurs, and Indian brands are going to be bigger than many multinational brands operating into India. So this is also one more thing we need to look for. Now, which are the stocks which you can accumulate? So in SIP form, we have released the report, and this report is available on our website. And if you need, you can also write to us and we can email it to you. There are stocks like Axis Bank, Bharti, Infosys, Larsen and Toubro, Reliance, State Bank, Tata Steel, and Ultratech Cement, large cap blue chip stocks, where you can do SIP continuously over the next year. And if you accumulate this stock throughout the year, it is likely to give you good returns going forward into 24 and 25. If you are looking for a stock fix for specifically for the year 23, we also released one more report, and where we have issued 8 stock which look good to us in the year of 23. So these are ACC, Bharat Forge, Chennai Petro, Indian Oil, Larsen and Toubro, PNC Infra, Power Finance, RCF, SBI, and Zensar. Some of the stocks like PNC and Power Finance have already started performing and are up into double digit in just 3-4 sessions of 23. But overall, as a basket, these companies are likely to do better than the index over the next 1 year. Now, let me also briefly talk about the gold and the currency. So we remain optimistic on the prospects of gold. Central banks have started accumulating a lot of gold, and physical purchases are likely to be higher, though the monetary investments, the money which was going into in the form of digital money into the gold has started reducing. The central banks are gradually acquiring a lot of gold. So this is a positive news. We are moderately bullish on the yellow metal, and we think that in dollar terms, we see that it is appreciating about 5 to 6%. In dollar terms, we think that between now and 1915, you could see gold. If there is global recession, and then if there is dark prospects for global economy, gold price can even shoot up to $2,100 also. So this is a good hedge, about 5 to 10%, depending upon the risk appetite. You should keep gold in your portfolio. Indian currency had a terrible year. It is depreciated by a lot. We think that next year it is going to be a little range bound. On the higher side, we expect 84.25, and on the lower side, if India were to be included into global bond indices, or the global funds start putting a lot of money into India, then it has a room to be appreciated to the 78 to a dollar also. So we expect that the foreign institutional investors will become net buyers. We expect better macro, and we think that the US interest rates and inflation will peak out in 23. That will lead to a fall in US dollar index, and that will be the beneficiary. And if India is part of the global sovereign global bond indices, we can see a large impact. So that brings me to the overall strategy. How should we play the year? So post reopening of the Indian economy and subsequent to COVID related lockdown, our demand is broad based, and we are witnessing it across the industry. We see that the supply side disruption are reducing, the surplus liquidity is also getting over, and interest rates are gradually becoming higher, but they are reaching near peak. So the demand side dislocation, which impacted the inflationary environment, is easing. As a result, corporate India reported a handsome recovery in its revenue at aggregate level, but the profitability was compromised due to earning downgrades in last 2 quarters. And we think that the normalization of demand and softening of the commodity inflation will have a positive impact on earnings. We have observed the sign of cost inflation peaking in second quarter. In our view, the earning downgrade is largely over, and our universe of coverage suggests that the margin recovery is on the cards. We are of the view that the aggregate earning of our coverage is likely to go up by 34% from 20 to 22, and expected to now report about 11% earning growth in FY23, and that will also be followed up by another 13% growth in FY24. So earnings will be led by BFSI and auto. and it will also be supported by the consumer discretionary, pharmaceutical and real estate market. Aggregate, BFSI, auto, IT, industrial and cement are our sectors where we are positive, and we are expecting commodity inflation to soften. So we prefer large cap banks, real estate, industrial, capital goods, power. These are the stocks where we are looking for opportunities to invest. We remain underweight on small banks and consumers and energy and NBFC. Nifty currently trades at about 22 times FY23 and about 18 times FY24. So there is a risk to the downside to this consensus earning. Around 990 to 1,000 rupees per share Nifty EPS is there. Now over the next 4 quarters, we'll come to know whether this 1,000 rupees per share of Nifty aggregate earning is achievable or not. But it is at the higher end we are trading. So what is the advice? Advice for retail investors to be remain invested, make use of the optimum use of the SIPs in the mutual fund. If you are allocating to equities, do not over allocate. Keep your asset sizes right and automatically keep periodically keep checking your asset allocation. If you are heavily invested, keep room for important events like budget. If there is any negative surprise in the budget, if market comes down by certain percentage point, you should be have the dry powder to put that money into the market. Also, during the year, keep on consistently review your portfolio and without any consistent non-performance. Because if you think that the some stock which has not performed in your portfolio, and if it is a mistake, it is important to remove those mistakes so that we can go back to the CAGR, higher CAGR for our portfolio. So surgical surgery of or a clinical surgery of your portfolio is required from time to time to weed out the underperformance. If you are investor looking at the to invest in debt market, this is a very good time if you are not invested. Also remain wary of the IPOs which come with the where business model is difficult to understand and where profitability is not there. Last year, Indian retail and HNI investors lost almost 8,500 crores in IPO since October 21. Most of these IPOs of new age companies and insurance and AMC company where profitability was under problem resulted into losses for Indian investors. So one important message is to core portfolio, you should have a longer term time horizon, and once you have a high quality company, you can withstand the volatility. If you elongate your time horizon, eventually you are going to make a return. Market timing is difficult. Do not worry. You do not be aggressively invested in equity so that whenever there is a panic, you lead to a panic selling, and that may result into a lot of outsized opportunity cost. So it is usually the large fall followed by the best days of the market. So if market were to go down aggressively 5-7% within a span of few weeks, that is a time where if you have a dry powder, if you invest, usually the best days follow such worst days, and that's where you can make a lot of money. So that brings me to the end of this webinar. I hope the content has been useful. Now I have a couple of minutes. Let's take about 10 minutes. If you have any question, depending upon the screen you are using, you may have a question mark button on your screen. Please type in your questions and I'll try to answer as many as possible. So I'll wait for a couple of minutes to question queue to assemble. But in the meantime, I'll summarize. It's going to be a very good year for stock pickers. We expect that US market and global market, all the problems are likely to get over by the first half of the 2023, and by that time markets may have bottomed out in globally and in India. Now if you keep some dry powder now and invest into fall, the second half of the 23 is likely to be good, and that will build a base or a foundation for a bigger rally post 23. So Anuj Singh is asking, in 23 IT sector will move up or down? I feel that it will be not really a top performer, but it will give you about on aggregate 10% kind of return. There is a structural story. So if you have elongate your time period for IT stocks to 3 years, say from 23, 24, 25, then Anuj, it is going to give you good returns because these companies have a lot of earnings visibility. It is only this 1 year where we feel that there could be some volatility because there could be some delay in decision making from foreigners, and if there is a deeper US recession that can impact the earnings of the IT companies. So small PSU banks have already, Naveen Kumar is asking, is there any steam left? So small PSU banks have done quite outperformance, but there is some steam, but not all the lower quality banks. So I would say advise to you to keep exposure to PSU bank, but in a larger banks, the largest couple of banks, you should keep an exposure. That's where the most comfort are there. What are our top 5 recommendations? So we have curated 2 portfolios which is there on our website in the form of small case also. Mr. Anil Bhatia is asking, if you want to do SIP, this is a basket which is available, which are 10 stocks which you can do SIP over the next couple of quarters and hope to generate return over the next couple of years. If you are looking for playing this year, these are the 10 stocks which we have recommended. These stocks these are the stocks you should look at for particular year 2023. So I hope this answers your question, Mr. Bhatia. Bhavik is asking what is our view on AMC. So AMC had a terrible year. Many of them are trading near quite attractive level. We think that the bottom is likely to happen in first half of the 23. So right now we are underweight, and we hope that the after the first half, these stocks can start giving you good returns. If you have a longer term horizon, Bhavik, I think that the financialization of savings is a multi-year, multi-decade theme. There is tremendous room to earn from these asset management companies. There is a lot of room for them to increase their AUM. So keep a longer term horizon and start accumulating them in the first half of the year. You are likely to make good money. Ram Nanda Naik is asking, can we start accumulating good small cap? Yes, we do recommend that small cap are likely to outperform the other 2 larger indices. The problem is that these are small companies, they are not very well established companies. So your due diligence or your research should be very good in small cap, otherwise you are likely to lose money. So we do come out with many recommendations in small caps. I would advise you to look at our website from time to time in fundamental ideas. There are small caps which we cover, and I think you can invest in them. They are likely to be the biggest beneficiary in 23. Arpit Gupta is asking about metal sector. So huge event has happened. The China has now stopped following their zero COVID policy, and that means the Chinese consumer are going to now come out and spend. That may have an impact on commodity prices, and commodity prices are likely to go up in 23. And that means that Indian commodity companies are also likely to be major beneficiary of higher prices. So I am positive on metal as a sector for 2023. Mr. Rohan, I will not be able to answer any stock specific question. Oh, there are so many questions. I'll take another 2-3 questions. Stock specific questions we will not be. SIP, will it be fruitful in mutual fund or equity? So it depends upon risk appetite. If you have the ability, Mr. Prashant, to look at these stocks individually, then I would advise you to look at the SIP stocks which we have recommended or investment ideas. If you do not have the ability to understand the risk involved in direct equity, it is better to give it to mutual funds, and they professionals are there to help you out in this manner. So it depends upon your experience and your risk appetite. Silver is also bullish, Mr. Bhatia. We feel that it has a high beta compared to gold. We expect about 5 to 7% growth in gold throughout the year, point to point. That means silver is likely to give you double-digit kind of a possible return from one point to another. Derivatives, I do a weekly webinar on derivatives, and we also have a derivative report which we put out on our website on a daily basis. I would advise Mr. Manjunath to look at our derivative report. Okay, global, is it a right time to? Yes. So if you are a good long-term investors, and if you have a 2 to 3 year horizon, gradually from first half of the year, Nasdaq stocks, especially the blue chip Nasdaq stocks, do look quite attractive. We do not cover them as we do not have any expertise to evaluate the individual stocks in global markets. But you are right; these many blue chip companies in US are available at a quite attractive valuation compared to the Indian counterparts, and we think that those companies do warrant a second look. We have a global platform, global investing platform on HDFC Securities. There you can go to that and open an account, and from there you can directly invest from our platform into global stocks also. So, Mr. Rahul, I suggest you type global investing HDFC on Google and you will get the link to open the account on global investing. I've tried to answer as many questions as possible. It's almost 45 minutes. I want to now conclude this webinar. I hope this has been useful to us, useful to you. Please write to us, share your feedback, any comments you have. This will be also uploaded on our website and on YouTube. If you want to refer to this webinar again, you can check our YouTube channel. Thank you all for joining and have a great weekend ahead. Thanks. I'm closing this webinar.